Hello, everyone. Welcome to Real Vision Live. For Real Vision, I'm Max Sweethy. I'm joined today by Michael Howell, the Chief Executive Officer of Cross Border Capital. Michael, thank you so much for coming back on Real Vision.
Great. Hi, Max. Great pleasure to be here. Thank you.
All right, so we're going to be talking all things global liquidity. You are well known. You've been on Real Vision before talking about why you think liquidity is the most important macro variable. For everybody who might not be too as familiar with your outlook, can you give us a brief overview of what global liquidity is, what it means to you, how you measure it, and why you think it's the most important variable to focus on?
Sure. If you look back over the last 12 months, the one number you'd like to have known is the picture for global liquidity. Global liquidity has empowered markets over that period. That's why stock markets are, recording highs. That's why Bitcoin's going up. That's why commodity prices are rising. Effectively, what we're seeing is this tide of liquidity. How do we measure liquidity? Liquidity is a global phenomenon. It's not money supply, as some people would suggest. It's much broader than banks. It looks at all credit and all savings flows that the private sector worldwide essentially has to play with. If you look at that, there's a chart that we can flash up, which basically looks at the growth of global liquidity over time. And global liquidity now is a figure of about $160 trillion. It's likely by end 2021 that will reach about 180 trillion. That represents about 200% of world GDP. And to give you an idea of how fast it's grown, about 20 years ago, that was 100% one times world GDP. So it's clearly outpaced very significantly. Now, one of the things that you can say about this growth of liquidity is that China has played an increasing role. And that's one of the features I want to bring out because China's role in global liquidity is absolutely critical, certainly now, but also looking into the future. China now represents about 29% of the total pool of liquidity. It has outstripped the US, which is about 22% of that total pie. US dollar liquidity is probably more important, but China is coming. And we don't take the view that China is a sort of basket case that's going to derail. China is a real threat to everybody in the West. And the irony in this whole picture is that when the US and the West basically began this pivot towards Asia and China in the 1970s, by empowering China industrially, they ultimately weakened the West financially. And that's really the critical point.
Okay. And so when you say that China is the dominant force for global liquidity, what does that mean? Why does it matter where the liquidity is coming from?
Well, it matters because China is basically controlling its pool. And China's control means that it can direct liquidity into certain areas. Now, what's more than that is that the yuan can be empowered as a currency in use. And I think that, a lot of people will dish the idea that the yuan is ever going to eclipse the US dollar. But I would just say, just wait and watch. And if you look at the history of the US dollar, people would have made the same claim about the US dollar not really outpacing sterling in, let's say, 1913 before World War One. Basically, within 4 to 5 years, the US dollar was the dominant currency worldwide. Why was that? Basically, there were two reasons. Number one was a world war whereby British banks were not allowed to lend internationally anymore for obvious reasons. And number two was because a lot of trade, munitions or food or whatever, was basically in US dollars. And the US started a trade finance industry almost from scratch. And that trade finance use of dollars basically meant every other country had to hold dollars in their portfolio and use dollars. Now, the Chinese are the world's biggest importer and exporter. It would be just a flip of a switch or a sort of a pen stroke that would cause China to switch from denominating in dollars to denominating more in yuan. And they could use Chinese banks to actually develop a trade credit industry very, very quickly. On top of that, if you look at how China is growing, its economic model, it depends very much on exports and it depends a huge amount, obviously, on infrastructure. Now, how does infrastructure get paid for? Fixed income financing, bond markets. What has China just done in the last couple of years? It's opened up its bond market, and the bond market in China is drawing in global savings. That's one key thing. The Belt and Road Initiative, as people talk about, is alive and well. That's a major conduit of Chinese future growth. The second thing is looking at trade and trade finance, which I touched on, but equally think about the digital yuan. The digital yuan is here, it's being used, and that will allow peer-to-peer transfers within a Chinese trading zone. And that Chinese trading zone will probably extend into Central Asia. So what you've got is clear economic and clear financial threats coming from China's increasing control of liquidity and its role in global liquidity.
Well, and as well, if you look at the political climate, it doesn't strike me that the U.S., if you make that analogy back to World War I, where the UK banks were not allowed to lend, there's nothing that extreme coming down right now. But certainly the narrative is more towards U.S. firms potentially being limited in their ability to deal with China and to deal with the rest of the world, whereas Chinese firms are being encouraged to go forth and multiply. Yes.
Exactly. Very similar analogy.
Okay, well, this chart that you showed before of global liquidity over time is very helpful, but there's another way to look at it, which is your global liquidity index, which I think helps put it into context how much, where we are sort of in a shorter term. So I have the chart up here of your global liquidity index. How do you calculate this, and what is it showing for you?
Yeah, it's an index that basically uses that same data set. It looks at the momentum in liquidity. It has a slightly different weighting system, so it's actually created mathematically. But basically, what it tries to show is the importance of different parts of the whole liquidity pie. And what the index is demonstrating is why liquidity or how liquidity matters principally for financial markets. Now, we tend to look at the role of liquidity through, if you like, three different lenses. The total flow of liquidity tends to impact the fixed income markets, and it primarily drives the yield curve. The yield curve is probably the most important number, I think, to look at in terms of most financial variables. The yield curve was actually a device, if you look at the history of it, that was originally devised back at Salomon Brothers in the 1970s, and it came out of the demise of Bretton Woods, where up to that point, basically the finance industry looked at different yield tenors as being separate markets. The Salomons and Marty Leibowitz, who was head of research at Salomon Brothers, said, look at the curve as a continuum. Look at the yield curve and the term structure. What drives that term structure is liquidity. And if you get more liquidity going into the system, you'll see the yield curve steepening. And if liquidity leaves the financial system, the yield curve will flatten. And that operates via term premium, a slightly wonkish idea, but that's what's happening. What are you seeing now in yield curves worldwide? And I believe there's a chart that you can see there, which is somewhere around about I think the slide 8 or whatever in the pack I sent. What that demonstrates is that there's a very clear connection between the flow of liquidity and the yield curve. And that is almost a cast iron relationship that has worked on the chart visibly for 20 years. But we run that right back to the 1960s and 70s. It's absolutely intact. At Salomon Brothers, that was a key factor that traders would look at. They'd look at liquidity flow and try and understand how the yield curve and the fixed income markets were moving. So number one is the flow of liquidity. That's definitely telling us that yields are still going up and the yield curve is steepening, which must be great news for cyclicals and value stocks. And it's not a great time for growth stocks. So that should really empower that part of the financial markets. The second thing to think about is effectively the mix of liquidity, the quality mix of liquidity. Liquidity has good parts and it has bad parts. The good liquidity is what's created by the private sector through basically profitable operations or by profitable lending. That's good liquidity. You also have a slightly, let's say, a bad liquidity. It's not necessarily all bad, of course, but call it bad liquidity, which comes out of the Federal Reserve or central banks. And we think of it in good and bad terms because that's the impact it has on currencies. So if you get lots of good liquidity in the US, private sector is generating lots of cash flow, the dollar's going to be strong. You get the Federal Reserve coming in and printing lots of money, the dollar's going to weaken. And it's that balance which really drives the movement of the US dollar. And I believe there's a chart which we show there, which is a little bit later, maybe it's the following chart, which we look at what we call Forex Risk. And that is measuring the differential between private sector and central bank here, Federal Reserve liquidity. Now, what you can see is that indicator is charted alongside the DXY index as a rate of change. And what that basically illustrates is that the Forex risk measure, in other words, private sector minus central bank liquidity, is a very, very good lead indicator of the dollar, future dollar. And what it's saying is that the dollar is coming through a period of moderate weakness. Now, the problem about the dollar is the starting point. And in terms of our view of how things are unfolding, one of the things that we would highlight is the capital flow picture, because that also impacts on what the currency will do. Now, the problem that the US dollar area has is that we've just come through a decade where there's been huge demand for dollars for a number of reasons. We've seen that historically before, where you've seen these sudden bouts of dollar demand. We saw it in the 1980s with Japanese insurance companies coming in to buy the dollar when there was deregulation of the Japanese financial system. We saw it in the mid-1990s with the Asian crisis, where basically the dollar was the main safe asset which Asians poured into their savings for, if you like, safe haven demand. What we've seen in the last decade is a lot of demand for dollars for three principal reasons. Number one was you've got the Eurozone banking crisis from 2010 to 2012, which made a lot of capital fled the Eurozone into the dollar. Secondly, what you saw was the anti-corruption drive in China of Xi Jinping, and what that meant was capital just fled China into US dollar assets. Thirdly, what you've seen is regulation through Basel III, Solvency II, which have actually increased the demand for safe assets, and the obvious safe asset is US dollars. So we've had a decade where there's been unprecedented demand for US dollars. So the dollar's coming off a high. And basically, we think that will dissipate. And therefore, that's another reason why you've got problems looking forward for the dollar. That's not necessarily bad news for financial markets, after all, because financial markets do well if the dollar's moderately weak. You've also got evidence that foreigners are starting to bail out of treasuries. And I think there's evidence I put in a chart there, which is showing that we've had in the last 4 or 5 years about $1 trillion of net selling of treasuries by foreign holders. So all these things are weighing down on the dollar. So our view of the dollar is about the relative flow of liquidity. And then if you come to equity markets, equities, if you like, the third asset, is all about the positioning of liquidity within portfolios. Now, many people talk about there being a bubble in equity markets. There may be bubbles in certain areas, but there's certainly not a bubble overall. And if you look at the relationship we focus on, which is the total value of all equity holdings divided by the pool of liquidity, that ratio is actually at pretty median levels. It's about 0.5. If you go back to Y2K, the tech bubble around year 2000, that got up to about 0.85. And if you look at the global financial crisis 2007-8, it was about 0.71. So at 0.5, I mean, we don't seem to be stretching things too far. US is a little bit more stretched than the other markets, but not dramatically so. And I think the key point to make about equity markets in general is that how much they sold off a year ago. There was so much cash on the sidelines, and that's been added to by central banks, as we know. So hence, more money, financial asset prices go up.
Okay. So there's one thing I noticed is a lot of people have been talking about this recent dollar strength as just a simple result of real rate differentials, and that you're getting rising rates here in the US, and that's going to pull in capital. Seems like you take a more nuanced view of what drives capital flows and what drives dollar strength. So why is real rate differentials not enough?
Well, if you look at if you go back and analyze currency movements, and I've tried to make real rate differentials work as a driver, they just don't. I mean, they tend to be a lagging indicator, not a leading indicator. I mean, people are welcome to prove me wrong, but I must say I've never found any evidence that they work. What really matters is flows of capital, and it's fair to say that if you look at the recent performance of the dollar, okay, the dollar's gone up, but isn't that to do with the fact that the US economy is doing rather better than the Eurozone right now? And consequently, there's more, as we would say, good liquidity being created. It's simple as that. The problem out there is that somebody's got to fund these whopping great deficits, and that may be the good old Federal Reserve. And the issue is that the Fed's basically come up to the plate for 2/3 of the debt issuances we've seen, and maybe they're going to be called upon for more. So I think the problem looking forward is you've got this mix, which is not exactly a great mix for the dollar. It may be good for the US economy overall, but it's not necessarily good for the US currency.
Okay. Well, I want to talk a little bit about risk exposure. So we've got a picture of liquidity, and you touched on positioning and exposure a little bit, but you have another chart on chart 13, which I must confess I need you to translate for me.
Yeah, okay. What that does is basically the chart that I previously alluded to, which was total equity holdings divided by the pool of liquidity, is a very straightforward, simple indicator. But markets are a little bit more complex than that. You've got to look at other asset classes. So the chart that you're looking at is basically looking at a mountainscape of all asset holdings worldwide. Now, through the miracles of technology, we can get this data now very speedily. And for certain countries, we can get it daily with about 2-day delay. So we can update and refresh these numbers very quickly. So what we do is we look at the positioning of equities or risk assets in general within portfolios, and that really is a good guide as to, if you like, valuation or likely performance. And basically, what that data shows is the positioning of investors worldwide in risk assets. Now, you can read that as equities, and it's taken relative to safe assets. So you can take safe assets to be cash and government debt. So what that barometer that you're looking at on the right-hand side basically is looking at is that barometer of risk positioning in markets. So that's, if you like, a good guide to risk on and risk off, but actually where investors are currently putting their money. So we tend not to think about surveys because investors don't always tell the truth. They talk about aspirations. We look at where they actually put their money. And that's really the key thing. Now, if you look at the chart closely, you'll see another line on that, which is looking at world economic growth. And the remarkable thing about that chart, or the two lines, is that asset allocation is remarkably pro-cyclical. So investors tend to put more into risk assets, i.e. equities, when the economic cycle is picking up, and they basically take money out of equities and put it into safe assets like government debt and cash when the economy is turning down. Right now, economies are turning up, therefore you want more equity exposure. And there's another set of charts, I think, that we've got maybe in the next slide on, which shows those particular risk appetite or risk positioning indicators for the four big markets: the US, Eurozone, Japan, and the UK. Now, if you look at those, none look particularly stretched. Wall Street, despite the highs, equally doesn't look that far out of line. UK looks positively cheap on this positioning chart. It's been left way behind by Brexit and the original COVID concerns. It's lagging seriously, but it's going to catch up at some stage. And what those charts in each four of the cases highlight is the extreme pessimism and risk off that occurred a year ago. These were just numbers off the scale. And that's why it was very clear at that time this was a great buying opportunity a year ago. You can still make money out of stocks now, but clearly there's a lot of water is under the bridge. But there are opportunities. It's not a time to sell medium term in equities. However, one of the concerns that we do have is that the strength in economies right now, and you can see that in the latest ISM releases at the beginning of April, is that the momentum in the American economy is basically very high. That will be pulling liquidity out of financial assets and stocks and bonds, and it will be pulling it into working capital and maybe spending on the high street. Those factors are likely to cause a wobble in Q2, Q3 of this year. Now, our sort of, if you like, our view or profile of the year has been to say that we were bullish in the first quarter for all the reasons about bounce back of economies, and the amount of liquidity that was being thrown in, we've basically always been pretty cautious about Q2 and Q3, thinking that markets may get a pullback through here. That pullback may be underscored by the fact that you've got bond markets which yield curves are steepening and bond yields which are rising. I mean, as we've said in our research, look, put this in context. This is the worst run the U.S. Treasury markets had since the 1950s. Okay, in terms of length of duration of sell-off, this is big. It's probably still got further to go if rates renormalize. So that is going to be a weight on equity markets, and therefore Q2, Q3, we think will be an opportunity to maybe buy back into markets on further weakness, and then by Q4 maybe there'll be a rebound again.
Okay. So, if I were paying attention to most of the mainstream financial media, I would be thinking that what's happening in Q2, Q3 is a bit of a, buy the rumor, sell the fact sort of stuff. But you're saying that there actually is a mechanism under the surface that you believe is really driving this more than profit taking from investors.
Yeah, it's all about liquidity. I mean, the fact is that strong economies do not have strong financial markets. And what's the reason for that? It could be that central banks tighten. Sure, they're not going to do that, obviously, right now. But the other reason is that money gets drawn out of financial assets, out of the financial circuit, into the real economy circuit to fuel working capital demands and consumer spending.
Okay. So you brought another chart that the first one we looked at, you can see that the UK looks relatively cheap based on the risk exposure, but you have another one that's ranking all of the world markets. Can we go through this
Correct.
here? And this is again based on risk exposure. Are there any caveats you would like to give? Are the ones at the bottom, I see you have them circled as the best opportunities. Is there ever a reason why the risk exposure is this, it's sort of like what people say about value stocks, like oftentimes there's a reason it's cheap?
Yeah, it's true. I take your point. I mean, I think there are two things to say on that. I mean, one is that basically one of the laws of financial markets is mean reversion. I mean, that happens an awful lot, and what you want to do is effectively go against the crowd. So be a contrarian in that respect, and you will effectively revert to the mean. So if you're buying stocks that are out of favor, they tend to do well. This works much better at the market level. Now, if you test this particular analysis, and we do this, we run money on these, on this philosophy, is that basically if you buy at these sort of very low levels, which let's say are 2 standard deviations below normal levels of risk exposure, you tend to make something on a 2-year view 30 or 40%. Okay, if you do the opposite of that, and you tend to buy at the highs, let's say 2 standard deviations above normal, so the tram lines on the earlier charts that we were looking at, you'll probably on average lose 10 or 15% over 2 years. So 2 years is a good time to sort of see if these strategies work or not, and that's the evidence. Now, another piece of evidence is to say, well, okay, if we'd have drawn that chart at end of April 2020, which market would have been right at the bottom? Wall Street. Absolutely right at the bottom of that. Risk exposure got down to unprecedented low levels because investors panicked. There would have been great opportunity to buy at that point.
Okay, so when you're talking about these opportunities, are they opportunities for right now, or are they something a little bit later in that Q2, Q3 period where we could see a wobble?
Yeah, I think that it would be better to be buying after a wobble for sure. Maybe there'll be opportunities in other markets too. But I think that on a 2-year view, what we're saying is that these are the markets that will likely outperform.
Okay.
Whereas if you look at some of the things at the top, they've already had explosive growth. Some of the Asian markets, some of the involved in semiconductors or whatever it may be, they've really have powered up. There's actually profit taking going on in some of those markets right now.
Okay. Well, I see here that there's a good mix between developed and emerging in that opportunity set. I mean, you have South Africa all the way down at the bottom, but then you have the UK, New Zealand, Canada. I guess Portugal is a developed market as well. So you have a good mix of DM and EM there. Do you have a favorite in terms of DM versus EM in that opportunity set?
I think in terms of let's say on a 2-year view or so, I think that the developed markets probably still have the edge. emerging markets have not got the same liquidity impetus as some of the developed markets have, because central banks have not had the opportunity yet to, if you like, increase liquidity at the same pace as the US has, or Eurozone, or the UK. So that's missing. But one of the things that you will see upcoming is that as the dollar starts to weaken, as we suggest, what you're going to start to, or you're going to begin to see, is more and more evidence of emerging economies, and particularly some of the other Asian economies, starting to monetize these capital outflows from the US as they move into these economies. And you're already beginning to see foreign exchange reserve growth in these economies beginning to accelerate. Now, that's a source of liquidity, and that will basically mean these economies can start to outperform. Now, one of the great mysteries which we've written about in our research that you've seen in the last, let's say, 3 or 4 years, and this may well have evolved out of something that was called the Shanghai Accord in 2016, is the remarkable degree of stability in Asian currency units. I mean, look at the yen dollar. I mean, I've never seen the yen dollar as stable as we've seen it in sort of 30 years of being in markets. This is unbelievable. Asian currencies have basically just come off their lowest ever volatility score, which was, if I recall, was about 3 or 4% at an annualized rate. Remember, back in 1997, the volatility of Asian currencies hit almost 50% at an annualized rate. I mean, this is just remarkable. So something odd is going on, okay? And I would say that something odd is that they're basically trying to manage their currencies as a block. And it may be that China is, if you like, the benchmark against which most of them are measuring it, but that's basically what's going on. So what you're seeing here is Asian currencies effectively stabilizing, and that will be, if you look forward, a great platform for emerging market investment over the medium term. Because if you get a weaker dollar and more monetization going on in the Asian markets, they stick with the dollar parity, but they get a lot more liquidity as a result. Capital is shifting towards Asia. So on a medium-term view, this may well be a recipe for strong outperformance from emerging markets.
Okay. And so when you say stability, that's relative to the dollar, relative to the
Well,
dollar, and
relative to the dollar. So you'll see Asian currencies, basically in nominal terms, pretty flat against the dollar over the medium term. What you're going to see is, therefore, there could well be a problem for Europe and the euro. And I think the whole issue that you've seen in the euro area is that the euro area, or the euro, is really the Deutschmark, old Deutschmark in disguise. And at some stage, people are going to start to recognize this more for what it is. And already what you've seen in the euro area is the classic example of a fixed currency system that basically empowers the rich and the powerful and the wealthy countries like Germany and parts of Central Europe. And it basically undermines the poorer fringes, like Spain, Greece, Italy, and to some extent France. Which country has got the worst debt problem in Eurozone now? Answer: France. And this is looking a serious question. And Europe is not, not the harmonious place. I mean, only a Brit would say that, but it's not the harmonious place that it's normally depicted. And you're seeing sort of the whole era beginning to fragment. Now, it may take some time for that to happen, but ultimately what you've got going on is that Germany is moving more and more towards Central Europe and ultimately Eastern Europe, and away from Western Europe. And that is a remorseless process, which you can see very clearly in foreign direct investment data. German firms are investing more and more in this region. And effectively, Germany is creating its own Belt and Road initiative, rather like China, but it's moving in the other direction. It's moving from west to east, not east to west.
so do you look at those Eastern European countries as a sort of like a high beta bet on Germany?
Exactly, they are.
So if you're bullish on Germany, bullish on the Eurozone, you should be bullish on Eastern Europe. That's really where you're going to get the most bang for your buck.
Yeah, well, I'd say you've got to be bullish on Germany, because I think the German economy is, you've even seen it in the latest data. I mean, even through this sort of COVID crisis, Germany's come out of this pretty well. And Germany is the manufacturing center, it's the industrial heart of Europe. And basically, German industry is moving more and more eastwards. You can see that, as I say, evident in the FDI data. It's very clear. They've shifted away from the West and including the US and more into this zone. And ultimately, although it seems a fanciful suggestion right now, Germany and Russia will basically tend to move closer together economically.
Okay. Well, you said it that the Deutschmark or that the euro is basically the Deutschmark. Well, if you're theorizing about a pan-Asian currency, does that mean it's basically the RMB and that is really the linchpin for your pan-Asian currency thesis is the strength of the RMB or really the stability of the RMB?
Yeah, I think that's right. I mean, the yuan or the renminbi, call it whichever you like, but I mean, effectively, what you've got is Asia. I think is coalescing around a sort of yuan zone, and that's very much in America's interest to try and stop that. If the US can, if it hasn't, if the if the thing hasn't already got so much power, so much momentum that it's difficult to stop. But effectively, this is really the threat going forward, and it's currencies which really matter in the future world. Now, what I think you're seeing worldwide is you're seeing this sort of growth in the yuan and the power of the yuan, and after all, seigniorage in currency terms is all important. Being able to sort of spend your paper money wherever you want and actually garner resources, and that's what China basically wants to do, and it sees that now. There's a sort of absolutely delicious quote that I may have sent you, which is well worth thinking about, which is basically coming from one of the key figures in the People's Liberation Army.
Mm-hmm. Yeah, I have that up.
It's Major General Chao Liang, who is absolutely explicit in what China wants to do, and he wants to displace the US dollar in Asia. You couldn't get more black and white than that, and he is often a spokesman for geopolitics in China. Now, that's the goal, and as I've said, China is moving to unhook itself from the dollar system. China re-exports dollars at the moment, and it needs to start exporting yuan to develop its financial power. And as I've said, the key issue for the West is that basically by empowering China industrially, it's weakened itself financially, which is why you've got this huge debt buildup in the West. And the debt requires liquidity, which is why we get into these problems. And basically, liquidity feeds off debt. So what you get is a debt liquidity spiral, which is effectively unfolding before us. And that is what we look at in terms of the financial market cycle. And the questions you've been asking me are, where are we in that cycle? Well, we're still in the upswing, but we'll at some stage get a downswing. Now, the problem is that central banks don't understand this process, or they haven't done until recently. And so what they've done is they've basically cut interest rates as a solution. Now, nothing could be more foolish if you want to dissuade people from taking debt up than cutting interest rates, because low interest rates are an incentive, are they not, to take on more debt. So what the central banks are doing by going to low interest rates, and God forbid in the UK, crazy people in the Bank of England are even talking about going to negative interest rates. So what you're going to do is to encourage more and more debt take up. But the point about debt is that it needs to be not just repaid, but more importantly, refinanced, because it has a term on it. So if you issue a 5-year bond, you've got to roll that bond over in 5 years' time. If you issue a 10-year bond, you do it in 10 years. What do you require to roll the debt over? You need balance sheet, you need liquidity. And the fact is that Western financial systems, the reason I say they've been weakened, is they've been turned from new financing mechanisms into refinancing mechanisms. So everything is about the roll on the debt. And every time that central banks step back and do a QT, they reduce liquidity. What do you get? You get a financial crisis. And central banks are forced to come back again. And that's the nature of what we've seen for the last decade or so. So every time that central banks step back, there's a wobble, there's a taper tantrum, markets come back and central banks are forced back again. And the reason is we've got so much debt out there. And that's really the problem. Now, China doesn't have that same problem.
Yeah, that was going to be my question: is what makes China not in this spiral?
Well, because the whole point about, let's get back to the stability of the financial system. What really matters for your financial system is the stability of your liabilities, okay? Now, if those liabilities are fragile liabilities, in other words, the funding structure of the liabilities is weak because it's dependent on shadow banks or the largesse of the central bank, okay, providing extra liquidity now and then at its whim, then you're going to have problems where the financial side of the liability side of the balance sheet periodically collapses, and then it has to be fulfilled again. So, in other words, the credit system is very, very volatile. And that's what we've seen in the West for the last 20 or 30 years. Now, in China's case, although people say, well, there's lots of debt out there, sure, but who owns the liabilities? It's the Chinese state, okay? So there's no problem about the integrity of those. And you may, the Chinese state, whatever you may think about it, has got lots of wealth it can easily deploy to underpin the system. And if you look at the power of China, I mean, you've got to look at the economic record here. I'm not blowing a trumpet for China, but all I'm saying, let's just get real here. China has come from nowhere. If you go back to 1978, China had something like 850 million people who were on the poverty line. Okay, now it's got 40, and it's soon going to get zero. Okay, China has basically enabled 300 million people to move from the rural areas to the urban cities to create this growth. Look at the scale of that. You look at the Irish emigration to America in the 19th century, that was 4 or 5 million. But look at the impact that had. China's got 300 million. It's creating 10 to 20 million jobs a year. So this is a real economy that's working. And now what they're doing is they're financializing it. So basically, what we're seeing here in terms of, let's say, our concerns is that the two big, if you like, focuses of investors are Bitcoin, in other words, cryptocurrencies, and MMT, or people's QE, or call it what you like. And those are just symptoms that our system is not working properly. Okay, you don't trust in paper currencies anymore. You don't think the economic system works, so you go down the route of cryptocurrency, and you go down the route of people's QE, or spending, which is being funded by the central banks. On the other side of the coin, China is actually delivering growth, and we may, criticize China for saying, well, okay, it's not real growth, or it's not phantom growth, or whatever they may be doing. But they're hitting the numbers. They're doing that, and the liabilities of the Chinese financial system are remarkably robust.
Okay, so if I were an MMTer, I hear this all the time, which is debt is money that we owe ourselves. But you're saying that that's not the case. We actually don't owe ourselves. It's the internet. It's the international nature of the ownership of Western debt that actually makes it a problem. But it's because the Chinese own all of their own debt. They owe all of the money to themselves. They're actually in more of an MMT framework where they can take advantage of these sorts of things. Is that what you're saying?
Yeah, there's nothing wrong per se with MMT. I mean, I think that if you look back at the history of capitalism or whatever, you've always used credit to grow. Credit's an important element. I mean, the issue is whether it's going into productive uses or not, and that's really the question. Now, if you were in Japan in the 1990s, 2000s, building, as they called it, bridges to nowhere, then that's sort of unproductive spending. Or if money is going into military uses and being destroyed, then it's not particularly productive. If it's going into financial assets, equally, it's not very productive, one would have to say. But if it's going into real projects, infrastructure or export growth or whatever it may be, then it is creating profits. And at the end of the day, that's what China is directing a lot of its capital to. And that's why the state-owned banks and state-owned industries are so integral to the system. But the fact is, if you look at the Chinese economy, and you look at the questions that people raise about it, one of the things to remember is that Chinese households only get 50% of Chinese income. Okay, the rest goes to the elites, okay, or the state-owned enterprises or whatever it may be, okay, or the party or whatever. That's the reason that Chinese consumer spending is so repressed, because they don't get very much income, and that means that there's a great dependency on capital investment, in other words, infrastructure, and on export growth. Which what it tells you is, number one, the Belt and Road Initiative and the expansion into Central Asia is actually critical for China's survival. And number two, what it means is that export growth and the competitiveness of the yuan is also critical. And that's why China is stabilizing the yuan against other peer currencies. So they've got this integrated supply chain area, which means that you don't let your currency shift a lot, and you try and keep it on parity with the US dollar as best you can. And that's basically what they're doing. It's very carefully engineered. So the whole idea that China is going to fall over tomorrow, I think, is wrong.
Okay. All right. Well, we got some questions from the audience I want to get to here. So we have a question from Stephen Pickering who says, do you see liquidity tightening again like last March? If so, could we see another USD spike? And then he asks any thoughts on the Australian dollar versus the US dollar.
Okay, number one, yes, it's coming because liquidity is cyclical. I think there's a chart that you can find at some stage, which basically looks at. We did we used some AI methods, some algorithms to actually try and say, looking at the liquidity data, can you put a pattern on it? And the pattern basically shows that what you seem to see is something like a sort of 60 to 70 month cycle in liquidity. And actually, even if you look at the COVID crisis, it seems to overlay on top of that cycle remarkably well. And what it's suggesting is you're beginning to see liquidity turning down. As I say, the reason that liquidity is turning down is not because of tightening right now, but it's because of money being sucked into the real economy. But hey, just wait, because central banks will ultimately make a mistake at some stage and over tighten again, maybe on inflation fears. So sure, it's coming, and then you will see another taper tantrum, because the problem that you've got is this huge mountain of debt that needs to be refinanced. And I come back to the point that the Western financial system is not a new financing system, as the economic textbooks say. It's basically a refinancing system. It's all about balance sheet, not interest rates. Interest rates are, I say, irrelevant, but they're not the main focus. And we can see that very clearly, I think, even in the last 12 months. Aussie dollar, US dollar, when it comes back to commodities, the strength of economies that we're looking at right now, we've been arguing there's a big V going on, that the momentum of all this liquidity, after all, all money that's anywhere must be somewhere. So it's going to travel into the real economy. It's going to cause a big economic boom. And what that will mean is more commodities. And China is instrumental in that as well. And as we've argued, China needs the growth, and it will do more infrastructure, and it will demand more commodities.
Okay.
Aussie dollar will go up against the US dollar.
Beautiful. Let's see here. Question from CB. So if liquidity includes fiat created by monetizing debt, isn't this fake liquidity that contributes to nominal price increases but not real value creation? Do you agree with that assessment by CB?
Not necessarily. I mean, it's the credit is always fictitious. Okay, that's how the banking and financial systems work. So what you're doing is you're effectively creating credit, advancing it with anticipation that you will get economic production coming. Now that may not happen, of course, and if you get unproductive spending as a result, then you will get this fictitious creation of liquidity. Now the question is, does that create high street inflation, or does it create financial market inflation? Now, our view is that it tends to most of the creation is financial market inflation. So that liquidity that's out there tends to find a vent more often in financial asset prices, commodity prices, house prices, than it does in real economy prices. I think one of the things that we've seen very clearly in the last few decades is that high street inflation is more and more a real economy issue than a financial market condition.
Okay. So I guess when you say that credit is always fictitious, is it when that credit is paid back that the economic benefit becomes real of lending that money out? When does it cease to be fictitious?
Well, it's, if you like, fictitious is maybe the wrong word, but I mean it's unproductive credit. So the credit's out there, and it either defaults or central banks come in and sort of monetize it, and then it keeps circulating. So if it does that, I mean, central banks don't like defaults, do they? So the too big to fail example. So in other words, if there's problems with the financial system overall, what they'll do is they come in and print money. The central bank will ultimately replace the private sector liquidity, and then you will get some form of inflation. And what I'm saying is that that inflation tends at the margin to be not high street inflation. It tends to be more often than not asset price inflation or commodity price inflation or house price inflation.
Okay. So we got a question from Michael who wants to know about, where you see currency risk. It seems like you have a slightly bearish view on the dollar, relatively, constructive on emerging market currencies, specifically Asian currencies. Is there anywhere out there that you see major currency risk at the moment?
Well, I think there's a major currency risk in general to paper monies that are being created by national governments. And I think we can see that in recently with the Bitcoin phenomenon and maybe the general crypto space. I mean, the world is moving in this area towards crypto in general, and I'm a great believer in that. The question we've got to ask is, which cryptocurrencies will survive? What are their uses? And I think that Bitcoin is establishing itself as a store of value. Okay, Ethereum probably is a very good medium for smart contracts. XRP looks to be, I would assume, to be the choice link as a bridge currency between these central bank digital currencies at some stage. I mean, it seems to have the architecture already there. So I think those ones make a lot of sense. I'm not too familiar with many of the attributes of the others, but you can see various uses. Now, the issue that you've got to question is, well, can central banks or governments demonetize these currencies? And that's clearly the big risk. Can they put legislation in place?
Yeah.
Well, they tried to demonetize gold, and they've tried many times to demonetize gold, but they've never succeeded. So that maybe gives you some confidence about the sort of durability, if you like, of Bitcoin. XRP is a more complicated issue, but I think the alacrity with which many governments are now sort of following with the central bank digital currency race, started by China 2 or 3 years ago. Everyone's now trying to catch up with the Chinese, seeing what the big risk is. What you still need is a bridge currency which sits over the top. And the only currency I can think of that has the architecture is the XRP unit. So that's another one to think about. So I would say the risk is coming to paper currencies from these crypto ones, but it won't be a straight line ride. That's for sure. In terms of paper units, I think the issue is that the dollar generally is under pressure from Asian units, and that's because most of the economic activity we think, or the economic power in the future, is lying in that region. Europe is much more of a deflationary bloc. You can basically see currencies in Europe appreciating in the short term, the euro appreciating because it's got problems. It's because it's a deflationary area. After all, if you go back to the 1930s and look at the similar parallel, the French franc was the strongest currency until it became the weakest. And it outshone everything else until the whole thing collapsed. And it did that just prior to World War II. So, you can see, maybe parallels going on there. But I would generally say that where I would be positioned in currencies right now is I'd be thinking much more about Asian units. I'd be thinking more about commodity-based currencies. And I'd certainly have, a serious investment in cryptocurrencies.
Okay. So Daniel has a question. With what we said about China being, really the key piece for global liquidity, how would more financial sanctions on Hong Kong impact global liquidity, the yuan, and then also HKD?
I think the answer is that any form of sanctions will disrupt things. I mean, there's no question about that. Anything which hinders the free flow of capital is going to be a problem. And, after all, what you've had is that the pool of global liquidity has been in many ways enhanced or boosted by offshore banks, offshore money centers, etc. The euro-dollar markets being a very clear example of that. But central banks have been trying in recent years to sort of corral that market together. And anything which now sort of further disrupts those flows is going to be damaging to global liquidity. Now, you could draw a scenario out that if you get huge disruption to global liquidity, maybe there is a risk-off event and the dollar goes up. That's entirely possible. But basically, what we see is a world whereby, certainly for the near term, what you're seeing is continual expansion in liquidity in the way that I suggested. Now, what about Hong Kong and what about what's going to happen to China? I think at some stage, it must be the case that the Hong Kong dollar and the yuan effectively merge together. I mean, I don't think it takes rocket science to work that one out. It's got to happen at some stage. And China will basically, in a situation where the dollar its access to dollars is curtailed, then it will need to get whatever sources of dollars it can, of which the Hong Kong Monetary Authority is probably a pretty convenient place to start. So I think that you've got, there are clearly geopolitical drivers here. But ultimately, I think that the world is moving more and more towards, if you like, two general currency zones. And it may well be ultimately a yuan-based zone and a dollar-based zone.
Okay. All right. So, Michael, we've had a couple of different asset outlooks. I think that we're going to wrap up the questions here. But I just wanted to quickly re-outline what your view is for global assets moving forward. So Q2, Q3, you said expect maybe a little bit of wobble in equities, but that's going to be buyable. You're constructive on emerging markets, but much more long term. You think developed markets have more edge over the next, call it 2 years or so. Asian currencies definitely looking strong, and then commodity currencies based on this expanding global liquidity picture, and then steepening yield curve and bearish on bonds. Is there anything else you wanted to add into that? Any color?
I think that one's got to emphasize the fact that at the end of the day, look, markets are cyclical. And if you look at liquidity, the reason that we talk about this debt liquidity spiral is that debt needs liquidity for refinancing, and liquidity uses debt as collateral. So the two things interact. Now, what you can see is a situation that, for example, is happening right now is that bond markets are selling off. Well, that's actually detracting from collateral values, and it's beginning to be an impediment for liquidity. So you can see evidence as to why the liquidity cycle could be at some stage topping out. I'm not saying tomorrow, but ultimately you get a cycle. And that's one of the things that we see. What you're seeing is much more pro-cyclicality in the whole system. Now, we think that at the moment you're in line for a midterm correction in markets. That midterm correction is basically is based on the whole idea that the economies are going gangbuster, and therefore they're going to pull liquidity away. That may well be a buying opportunity for sort of one last gasp this cycle for equity markets to rise through Q4, maybe Q1, Q2 next year. But that sort of period. Long term, I'd be looking at emerging markets. Long term, I'd be looking at crypto and non-US dollar currencies. Bond markets I still don't like. But I just think the US Treasury market, my long-term target's basically 2.5%. So I think for the 10 years. So I think we're well on the way there. And steeper yield curves, but that's going to empower cyclicals and value stocks.
Okay. All right, Michael, thank you so much for coming back on Real Vision, for breaking down global liquidity, and then as well, always for giving us a view on assets. That's very helpful. So thank you so much. And thank you to the audience for the great questions.
Great, Max. Thanks a lot. Thanks for your time. So long.
Bye.